Welcome to Wall Street Confidential. I'm Aaron Task, joined with Jim Cramer. Jim, you were traveling yesterday, so
Right.
a lot of ground to cover. Again, people are selling the news on technology earnings. We're seeing again in IBM.
Right.
What is the catalyst behind it? Is it just that they had a big move and you want to take profit here?
I think what's interesting in the IBM that strikes me is that you needed, after that 10% ramp that it's had since the year began, to have everything look good. But let's pull back for a second. That was the best IBM quarter I've seen in years. And the analysts were so quick to run from it as soon as the stock was down. The same thing that happened with Apple Computer. This is a very bad time to own tech. What you're really seeing is the seasonality in play. It's not the earnings.
Right, because people are looking to find a hair on the Apple earnings. Like the Mac sales weren't as good. And
that's what they do now. And you start thinking, well, hold it, the fourth quarter is always the strongest in tech. The first quarter is always the weakest. Let's just get out. We can get back in lower. And that's smart and right. That's what you should be doing. What's happening in the tech stocks is why you needed to lighten up dramatically. So that if you really liked IBM, you could start thinking about it now rather than riding it through what could be a considerable valley until we get more data points.
So now, 2 weeks ago you were here and you said you're pounding the table saying buy tech now.
Well, buy Cisco, buy Hewlett Packard. These are the ones that you can own through it. It's 40% of the... I look at tech like this. 40% of tech I like and 60% I don't. Now, that is still a lot more than I like for other areas. I do believe that tech will outperform this year. I think that there's two kinds of tech. There's this kind of product cycle driven tech. That's Cisco and Hewlett Packard and Microsoft.
And Apple, you're talking about.
And product driven. And then there's just all these kind of go along, using Texas Instruments as the template, kind of at the mercy of the market and nothing really new. And I think that if it's a nothing really new situation, a network appliance, a Citrix systems, a Rackable being the real archetype,
ugly, yeah.
Then I think that what you realize is it's too hard. And that's all I'm saying is that you had a great move in tech, including a 3% at the beginning of the year. Remember, 3% on the NASDAQ versus almost nothing for the S&P. You wanted to capture that. But once we got that, and I was debating this with my friend Laura Caniglio, she downgraded tech at the beginning of the year. I said, no, we're going to have a little bit more.
Right.
I want that 3%. I always want to be, at a certain point, greedy when I sense there's a great move. I remember giving a speech in February of 2000 saying you can still own the dot-coms. And then they went up from the month of February 1 to March 15. You got about 1,000 points in the NASDAQ. And everyone says, oh, Cramer, you should never try to take that. That is nonsense. Think about 1,000 points in the NASDAQ now, what you wouldn't do to get that. So I wanted to get that outperformance, but then the outperformance occurred and you had to leave.
Right, and people still criticize you for that. You
they
got to
always
own
do.
this. You got to own these stocks now.
My take on the criticism is always, look, I was money. I mean, that's all I was. I mean, you could argue that perhaps I was too all money. But what I was about was trying to beat the market on a daily basis. Now I'm trying to, in this conversation I have with you, give you a sense of how to beat it on a daily basis for what I did in my hedge fund. I tend not to talk about that for the rest of all the venues I'm in because, for the most part, I'm trying to take a longer-term perspective. But when I see what's going on,
do in those other venues. That's my sense.
Yeah, well, when I look at what's going on with IBM, I mean, I've been on the phone to two IBM analysts who they gave me the snapshot when they read the press release and saw the metrics. They both loved it. And then they saw the stock down, and suddenly they turned on it. And what I was telling both of them was, all you're doing is fighting the calendar. And now you're recognizing that the calendar prevails here. The calendar for industrials is really good. The CYC hits a 52-week high today. The calendar for banks is really good. The calendar for drugs is really good. So if those areas right now are so easy, why take on something that's so hard? Critical limited, people don't understand who are not hedge fund managers and maybe not mutual fund managers. You have a limited amount of bandwidth, so you got to figure out what to focus on. And what's happening right now is they're leaving tech. They're not focusing on oil. Sure, you're going to get a Schlumberger, which is basically saying, look, we don't care what you say. We're going higher, which unfortunately no company's as big as the market. But so that's what I see going.
That trade that you're just talking about, a lot of that would seem to be predicated on this idea that the economy is going to weaken and we're going to get a Fed rate cut.
Absolutely. I mean, I listened to, there's a guy, Steve Leisman, who is at CNBC, and not to denigrate people directly by name because he works very hard. But his thesis is this top-down thesis. They're speaking with Fed officials, and the economy's really strong. We look at the Federal Reserve beige book. That's nonsense. All that is just looking at what's happening now. What you have to look at is what's going to happen 6 months from now, because you can't make any money with what's happening now. A lot of journalism at my network is coincident, and that's why it's like reading yesterday's paper. You want to read tomorrow's paper.
That's what journalism is by nature, though. In a lot of places,
look, this isn't financial. I don't know. If I'm watching ESPN, which I regard as being the pinnacle of journalism, it's not at all about that. It's about whether there's going to be Schottenheimer ball,
right?
Marty
who's
ball.
Who's going to win the game? Right?
I think that the template for us is the template for all gambling, which is the ESPN method, and I don't excuse those who give us nothing. I think that they need to break template. We are not in a world where it helps you to know what IBM did yesterday.
Right. So what you've been saying is that who cares what the macro data is showing that the economy is getting straight?
The macro data is wrong because
it's
it's
stocks
only
that matter.
It's macro data is only the past. I mean, look, it's right for the past. I mean,
right.
Leisman is correctly.
The fourth quarter was better than people thought it was going to be.
He's correctly articulating what happened. But Ingersoll Rand from 36 to 41 is correctly anticipating what will happen. And our viewers need to know what will happen. It's very of limited value to know what has happened. Let's take Pulte Home. Pulte Home reported a really horrible quarter. I happen to dislike Pulte as a home builder. And having tried to buy some land, I've been bidding in my real estate property. I've had to bid against Pulte Home, and they paid outrageous prices for stuff they're now writing off for a fraction. But you have to understand that stock is not up today because the market's stupid. It's because the Fed's going to cut. Washington Post headline, inflation hits 3-year low. Another thing that the journalists do is they just presume, they only look at one side of the equation. If there's strong growth in employment, or if there's decent pricing power, but not great, they say, hey, listen, the Fed doesn't need to do anything. It's going to be on hold. No, the Fed's job is to stimulate growth when there's not a lot of growth, and the Fed's job is to stimulate growth when there's not a lot of inflation. And we don't have a lot of inflation. People are just not looking at that at all. $2 gasoline year over year. We could have negative PPI 3 months from now.
Well, what if you're wrong, though, about that Bernanke is going to do the quote-unquote right thing? What if he makes a policy error and says, you know what, year-over-year CPI is at 2.6% core basis, and that's above my quote-unquote target range, and I don't want to be seen as the guy who throws money out of a helicopter.
Well, you know what? I'll tell you. I think that's a good object lesson to ask that question, because the answer is that of course I could be wrong, but in the end I'm making a bet.
Right.
I think one of the reasons why journalists don't want to go there is because they fear being wrong. I don't fear being wrong. I fear being wrong more than I'm right. But in the end, if I'm right a little bit more than I'm wrong, I know I can make big money. The May rate hike was a big mistake, and the market got caught leaning the wrong way. Right. If the Fed doesn't cut, the market will again be caught leaning the wrong way. But in the interim, it's in the future. It isn't going to be now. We don't annualize the peak of inflation till May. That's why I've been saying post-May meeting, you're going to get a cut, because the journalists are looking at what happened last quarter. I'm looking at what will happen year over year, and you're going to get a moment in 3 months from now where you're going to say, oh my God, our rates are at 5% and we have negative inflation. Who can justify that? Which is why when you look at the bank action, the inverted yield curve is horrible, just horrible for these banks. And they're hitting a new high.
Right,
they're hitting a new high. So, I mean, we can look at what has controlled us currently and in the past. Inverted yield curve, weak housing, Schlumberger saying that oil is going to be high. Or we can look at the reality, which is that housing will get stronger when the Fed cuts. The machinery stocks are going over because the Fed will cut. And I just believe in the stocks. Like I said, stocks can be wrong periodically, but they too are right more than they're wrong.
Right, so you want to be in the cyclicals here, you want to be in the financials?
I think you want to pick, yeah. I mean, the one that is so outrageously difficult right now is Caterpillar, because Caterpillar's been staying at 60. You could argue that how much of Caterpillar is oil and how much of Caterpillar is home building. But that, to me, there's always keys to the market stocks. Cat is, whichever way Cat goes, I will tell you I will have much greater certainty. If it goes against me and goes down, I'm going to reconfigure my thesis because it's that important to this moment. But I think you're going to start seeing it climb.
All right, Jim, thanks very much.
Thank you.
I'm Aaron Task. Stay tuned for more of TheStreet.com TV.